It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.
And in this week's podcast, we are going to cover the public debt issue of Navi Finserv. And before that, what is Let's Talk Bonds about? Let's Talk Bonds is about all the fixed income investment options available for investors. And we tell you what are all the best options available to investors in the current market environment. Now, the market environment is all about risk aversion in fixed income. Interest rates are rising, central banks are cutting down money in the system, and inflation is rising very, very fast. And so with this, investors have to face a lot of issues apart from the fact that they are earning much less than inflation and fixed income. They also have to earn higher in returns as well as protect capital. Now, will Navi Finserv Limited, the new public debt issue, which is giving you higher returns, fulfill the needs of your investment at this point of time? And for financial advisors specifically, should they recommend this investment to their clients as a good fixed income options, given that the returns on Navi Finserv public debt issue is pretty much well above what the others are offering. Now, let's just take you through the issue details. It's opening on the 23rd of May, and they have two options, 18 months and 27 months in terms of maturity. And the returns it's around 9.57 to 9.59% for the 18 months, and 9.7 closer to 9.79% for the 27 months. And they also have monthly coupons as well as an option. And so those of investors looking for monthly coupons as a monthly income, then this is one option available. But most importantly, at 18 months, around 5.59%, and 27 months, around 9.79%. Where does it compare to? Let's take, say, 2025 Bharat Bond ETF, which is closer to 7%, which is the benchmark PSU AAA. So anything 5 years AAA is 3 to 5 years, or 18 months to 5 years AAA. It would be around 7/4 to 7.75, 7.75%. And if you go down the rating curve, or the other NBFCs that are offering microfinance companies, for example, would be offering around for a 12-month to 24 months, they would be offering anywhere between 9% to 10% kind of levels. So in that sense, Navi Finserv typically does compare to the other lower rated papers. Navi Finserv is rated A by the rating agencies. And while rating itself is not the greatest of considerations, because we need to look at other factors, but it does give you an indication of where similar papers are trading. So definitely the returns offered by Navi Finserv is very attractive for investors. But what they need to understand, and what INR bonds is all about, is to tell investors exactly what it is in terms of risk. So let's take the risk factors. Okay, first is Navi Finserv is a new age fintech lender, and they use technology to lend to unsecured loans to individuals and as business owners and others. And so the basic nature of the loans itself is unsecured, so it carries a lot of risk. How do you mitigate this risk? So Navi Finserv tries to use technology for better credit understanding, because they collect a lot of data, and use algorithms and AIs and others to actually sort out this data and arrive at the best solution and the best credit score for the borrower, so that the loans can be faster, and also that they can assess the loan better. The second is that, but even the fact is that given it's a new age, they don't have a very strong track record. So we don't know how the loans will perform in a bad period of time. And it does going to be going to be looking pretty bad with interest rates rising, money getting tighter, and if global issues affect the domestic economy as well, with geopolitical issues, and you see the equity markets falling very sharply, there could be some issues in the retail segment in paying back loans. And will Navi Finserv loans get affected? So this is one very big risk investors are taking, and we don't know how it will behave. The loans will behave in the 18 to 27 months. The other is that they made a loss in the first half of last year, but the fact was that was hit by COVID. But how do they mitigate this risk is through a higher capital. They have enough capital to cover all their losses, because and also they are not very heavily levered, as in they haven't borrowed too much to grow their asset size, and they still have a very reasonably low debt equity ratio, so that only when they grow the books very fast will they have a issue at this point of time. But the main thing is this issue is 300 crores, rupees 300 crores plus the green show of rupees 300 crores. And with this, if they start to lend very heavily, then they could be very highly leveraged. And when they are highly leveraged and the loans do not perform as expected, even with using the latest technology and the latest data analytics, etc., then there could be an issue for the company, right? And if there's an issue for the company, obviously there's an issue for the investor as well. The even more important risk factor, which we see at INR bonds, and which we put out our latest report on the search for yields, which is our weekly newsletter uh, available on YouTube, is there a corporate bond crisis coming up? Because we are at a scenario where inflation is very, very high. In India, inflation came in at 7.7 over 7.7%. The last time it was around this level was in 2014. And in globally too, US and Eurozone, inflation is at 4 decade highs. So there is a clamor to raise rates and also to bring down money in the system, because there's too much of money is making inflation rise very fast. And if inflation rises very fast, it can destabilize economies. So central banks have to be very careful. So when money comes down and interest rates are rising, the problem for lenders, especially NBFCs like Navi Finserv, is when their loans come up, when their bonds come up for maturity, the market may not want to replace the bonds. That means give them money to pay back the investors for maturity, on maturity of the bonds. So Navi Finserv will have to create enough reserves to make sure that they have liquidity to pay back investors. And when they start to create reserves, they might the capital because reserves don't earn them so much, the profitability will decrease, and if their NPAs rise, they could even face losses. So there are a lot of issues. Investors will have to find out first how Navi Finserv is going to handle uh, uh, a probable or maybe a possible liquidity crisis coming along. They must be very, very confident of making sure that they have enough liquidity to cover any kind of redemptions that are coming up in the next 2 years. And our own analysis suggests that in 2023, at this point of time, they have around over rupees 600 crores of redemptions that are coming up in bonds. So they have to be well covered for that. Apart from carrying out the businesses and making sure that in a stressful economy, that their loans also do well. So these are the risk factors. And like I said, INR bonds tells you as it is. While the levels are attractive, you have to look at the risk. And if investors and financial advisors believe that the returns are commensurate with the risk and the company is well managed enough to handle all the risks that could come up in the next 1 to 2 years, then they are safe to invest or advise their clients to invest. INR bonds has its own rating score. but this is available only for subscribers to INR Bonds, Quick Invest and Research. And those of you wanting to subscribe or download our app, Quick Invest by INR Bonds, where we give you the best bonds available for investments, most information, and we tell you what risk it is, because we don't hide anything. We're completely transparent, and it is best investors and financial advisors know that the kind of risk that can come about in investments in fixed income, even if the returns are higher, especially when the returns are higher. So with this, the other highlights of the week was that government bond GSEC yields fell from 7.5, close to 7.5% levels on the 10-year to 7.3% levels. And Bharat bond ETF 10-year too came down from 7.6 to closer to 7.5% levels. The 3-year 2025 Bharat bond ETF is trading at 7% levels. So this provides the benchmark for all issuers. Not too many happening in the private placement market. So the biggest issue that is now coming through on the public debt side is this Navi Finserv. And for public debt issues are very easy for retail investors. All they need to do is they can invest as low as rupees 10,000 and in multiples of that. And all they need to do is fill up a few details in an online form and give the UPI mandate. And this will be taken up by the Bombay Stock Exchange, who in turn will allot the bonds and exercise the mandate and then give the bonds to the investor demat account. The INR bonds is also enabling investors to invest in public debt issue. So download the Quick Invest app now and contact our customer support, and we will help you invest if you're an investor, and if you're a financial advisor too, we can help you give the risk. We'll tell you what exactly the risk your clients are taking, and we can still help you if you believe that the investment is worth it for your clients. Thank you very much for listening in.